Hi, this is CH. This video is part of a series of videos titled My ABCs or Absolutely Biased Comments on one mutual fund per video to share how an individual investor like you and I can try to find out more about a mutual fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I am not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the AB International Healthcare Fund. Snakes and healthcare are besties that go a long way. I'm not kidding. The Lunar New Year is coming soon, so I'll talk briefly about the Chinese zodiac, which happens to be the year of the snake in 2025. To be precise, 2025 is the year of the wood snake, the wood being one of the 5 elements and snake being one of the 12 Chinese zodiac animals. Wood also relates to spring and the color green. So 2025 is also referred as the year of the green snake. The year of the wood snake is typically considered a good year, as it symbolizes the shedding away of the old and unwanted things, like shedding off the snake's skin, and welcoming new life, like the green shoots growing in the spring. A very appropriate year for cleaning up your investment portfolios and adding some good investment ideas. I also like to take this opportunity to wish my viewers a happy Lunar New Year in advance and hope your lives will have many awesome changes this year. Now back to healthcare. The rod of Asclepius, which is depicted as a serpent entwined around a staff, is commonly used as a logo for healthcare-related organizations, including the WHO, hospitals, and medical services businesses. This is because this item belongs to Asclepius, who is the god of healing, medicine, rejuvenation, and physicians in Greek mythology. The snake is used as a symbol of healthcare as it is broadly believed to be due to the ability to shed skin, which symbolizes new life, and also that snakes possess an anti-venom against their own poison, which is most appropriate for healthcare as the study of the poison or the illness and the associated cures and treatment. The concept of anti-venom is basically similar to vaccines. Compounds of the snake venom itself has also been researched and extracted for various medical treatments. In traditional Chinese medicine, snakes have been extensively researched and is regarded as a medical treasure, as most parts of a snake can be used for medical treatment, including the meat, skin, blood, and gallbladder. It is also common to see snake wine in some of the older TCM pharmacies. Therefore, snakes have been associated with healthcare since a very long time ago. The healthcare sector has been a performance laggard in recent years. Taking reference from the S&P 500 index, the healthcare sector delivered 35.84% in the past 5 years and was only ahead of consumer staples, real estate, and utilities. In the past 1 year, the healthcare sector was the worst performer at minus 0.94%, and one of the 2 only sectors that did not deliver a positive return in a generally good year for the US equity markets. However, diving deeper, we can see that the top 10 holdings within healthcare sector has had decent positive returns in the past 1 year, with Intuitive Surgical leading the pack at 65.43%. This suggests there is a big dispersion in the returns in the healthcare stocks, and it is therefore important to pick out the winners from the losers. Within the healthcare sector, the returns dispersion across the subsectors have also been big. Pharmaceuticals have been quite muted in the past decade, while healthcare equipment and biotech have seen large up move and drawdowns during the COVID period. This suggests investors with a long-term investment horizon should stick with the broad sector exposure instead of going for thematics or subsector focused strategies in healthcare. But with the year of the snake, changes are coming to the healthcare sector and potentially in a big way. The returning US President Donald Trump is nominating Robert F. Kennedy Jr. as the next US Health Secretary. RFK Jr. is known to be vocal about some areas in the healthcare space, including the usage of vaccines and weight loss drugs. So it is possible he will make some big changes to the US healthcare scene if he is appointed. There are obviously some objection noises, but even if RFK Jr. ends up not getting the role, Trump will certainly find another strong-headed person as the replacement, given he is also determined to make big changes with his Make America Healthy Again slogan. The healthcare sector has been progressively adopting technology and artificial intelligence through the years, and with the rise of generative AI in the past 2 years, billions of dollars have been invested to see how the newer technologies can further help to speed up medical research or automate mundane jobs or help to make better clinical decisions. Given the continued focus on AI this year, we should expect to see new AI-related solutions and breakthroughs in the healthcare sector. The healthcare sector has had better days in terms of performance. In fact, the US healthcare sector delivered about 77% during 2012 to 2013, compared to S&P 500's 50%, and was relatively stable when markets corrected in 2022. Given healthcare sector has been lagging in performance in recent years, this may be a good time to consider tactical allocations before the sector starts to do better. For global healthcare market, MSCI and S&P are the two main index providers that ETFs and mutual funds benchmark against. The MSCI World Healthcare Index shows that the US forms 72% of the index, Japan 4%, and the rest are mainly Europe including UK. The S&P World Healthcare Sector Index also has nearly the same composition, with 71% US, 4.5% Japan, and the rest across Europe including UK. While the US market is the main component of the global index and generally has a stronger performance, there are some healthcare companies outside of the US, such as Novo Nordisk, AstraZeneca, and Roche, that are big players in the industry and should not be missed. There are also practically no pure US healthcare mutual funds for global investors. So going for a global exposure has more flexibility in the investment choices. There are not many global healthcare ETFs available in the market. Here are 4 UCITS ETFs that have more than 500 million euro AUM, from Xtrackers, Amundi, Spider, and iShares. Of this, Xtrackers lead the AUM by a wide margin at 2.4 billion euros, while Amundi has the longest track record since 2010. Performance-wise, Xtrackers appears to have slightly better long-term performance, while iShares has the weakest even though it has the lowest TER. So I will be using the Xtrackers ETF to compare against the mutual funds in this category. Next, let's take a look at global healthcare mutual funds. There are actually not too many registered in Singapore, and I would avoid those with innovation or next-gen or thematic plays for this video. So that leaves us with only a handful to look at. From Fund Supermart, there are only 5 funds that have at least 5 years of track record. From AB, Janus Henderson, BlackRock, Fidelity, and UOB AM, which is sub-advised by Wellington. Performance-wise, AB has had better 5 and 10-year returns, but is lagging a bit on 1 and 3-year returns. With 7.05% per annum for 5 years and 8.34% per annum for 10 years, AB is the only fund that has outperformed the Xtrackers ETF. So this shows there is definitely alpha that can be generated by active managers in the healthcare sector. 1-year returns gap with Xtrackers ETF is a bit big at 6.5%, which may be a result of poor subsector bets, but will be a point of concern in any case. One advantage of mutual funds over ETFs is that mutual funds come with a variety of share classes. In this case, most of the mutual funds do provide Sing Dollar share class, which is useful for Singapore retail investors. Interestingly, as each fund have different currency handling policies, some funds, for example the AB fund, Has the Sing dollar share class giving better performance than the base US dollar share class? So, on long-term performance basis, the AB International Healthcare Fund has delivered the best performance across both mutual funds and ETFs available. Let's go through the fund in more details next to see if there are any other areas of concern. AB stands for AllianceBernstein, a US-based global asset management firm created from the merger of Alliance Capital and Sanford C. Bernstein in the year 2000. Both Alliance Capital and Sanford C. Bernstein were long-established investment management and advisory companies, founded in 1971 and 1967 respectively. AB manages over $800 billion worth of assets under management as of September 2024, with US business covering 61%. Active fund solutions are the main product offerings, with active equity solutions taking 1/3 of the business pie. AB advertises themselves as having 30 years of excellence in Singapore, with a nice video showing the Asia Pacific CEO and the Singapore sales team. The AB International Healthcare Fund is a sub-fund under the AB SICAV 1 fund family. AB SICAV 1 is set up as a Luxembourg SICAV company structure and is UCITS qualified. Singapore-wise, the fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. The strategy of AB International Healthcare Fund is straightforward. The fund aims for long-term capital growth through global equities in healthcare and healthcare-related industries. There is a flexibility of up to 20% to be invested in companies not categorized under healthcare sector. The fund uses both fundamental and quantitative bottom-up research to select 40 to 60 stocks with superior long-term growth characteristics. There is no elaboration on the process, although I imagine it to be an in-depth fundamental company analysis together with quantitative modeling on the business dynamics and price movements. Exposures cover across all subsectors within healthcare, and we will see the biases in the portfolio holdings later. One thing I like about this fund is that there is an elaboration in their approach to healthcare investing, which is to focus on companies with strong business fundamentals and already having profitable and proven product lineup. It is specifically mentioned that the fund does not bet on drug approvals and future pipelines, as these have high uncertainty and typically cause volatility to the stock prices with no fundamental basis. Benchmark of the fund is MSCI World Healthcare Index, which I briefly covered earlier. The fund was incepted in 1983, which gives it over 20 years of track record now. It has over $3.4 billion of AUM as of end 2024, which is a decent matured size for a healthcare sector mutual fund. Country allocation is about 3/4 in US, which is just slightly higher than the benchmark, and the rest scattered across other countries. Something I like here is that the fund is actively allocating into the Asia region, with a higher Japan exposure and also some small allocations in Australia, India, and South Korea. These are countries not included in the benchmark, so it seems the fund is finding good off-benchmark opportunities in this region. Subsector industry allocation shows about 40% in pharmaceuticals, that is in line with the benchmark, as this is where most of the larger size healthcare companies fall under, such as Eli Lilly, Merck, Novo Nordisk, and Johnson & Johnson. The fund has a slight overweight on biotechnology and underweight on equipment and supplies, but nothing looks too alarming. Top 10 holdings show a decent mix of pharmaceutical big boys, together with service providers like United Health and Cencora, as well as biotech names like Gilead and Vertex. The fund portfolio has 42 positions, which is considered a slightly concentrated play. Active share is 53%, showing a decent deviation of investment ideas from the benchmark. The fund is co-managed since 2013 by two heavyweights in AB, Vinay Thapa and John Fogarty, who are both the co-CIO of US Growth Equities. Binay has been covering healthcare research for his full 25 years of career, so he is extremely knowledgeable on the sector. John comes with a quantitative background, and I suppose with the decent performance of the fund, it does show that blending fundamental and quantitative research can deliver some good work. While fund performance has been briefly covered earlier, here are the calendar year and annualized time period performance of the fund. On calendar year basis, the fund has outperformed the benchmark 7 out of 10 years in the past decade. The underperformance in 2022 and 2024 dragged down the annualized 1 and 3 years returns, but the strong rebound in 2023 suggests the bets in the portfolio may not be bad, but just not market timed well. Long-term 5 and 10-year annualized returns show the fund is still a decent performer. The relatively weak benchmark numbers from 2022 to 2024 show that healthcare sector has been in a down cycle, while the period 2019 to 2021 shows what healthcare sector can deliver in good years. Share classes for the fund are straightforward. The retail share class used in Singapore is Class A and comes in accumulation shares only. The US dollar class was launched in 1995, while Sing Dollar and Sing Dollar Hedge were launched recently in 2021 and 2022. Track record for the Sing Dollar classes are not long, but comparing the performances so far, it seems the hedging cost is nearly 2%, which is quite high. So going with the US dollar class or Sing Dollar unhedged class are better options. There is also a Euro share class available. Management fee for A share class is 1.76%. Up to 75% of the management fee can be paid by AB to distributors as trailer fees. TER comes to about 1.9% to 2%, as other expenses for different share classes can vary slightly. Distributors are allowed to charge up to 5% subscription fees for A share classes, although I think anything more than 2% for equity funds is excessive. Finally, let's summarize our findings and start with the good stuff. After 3 weak years, the healthcare sector may see a turnaround in 2025, the year of the wood snake. Donald Trump and his new cabinet will likely make big changes in the US healthcare space. General technology advancements at the same time will also continue to push for new breakthroughs in the healthcare solutions. The AB International Healthcare Fund is a strong long-term performer that has shown to be better than both ETFs and mutual funds within the same category. AllianceBernstein is an established US-based fund provider with a long presence in Singapore. The two fund managers have worked together in this fund for over a decade and are very experienced. The fund strategy of combining fundamental and quantitative approaches in the bottom-up stock selection has delivered good results so far. Now let's go on to the bad and the questionable stuff next. The new Trump administration as a catalyst can potentially lead to increased volatility in the healthcare sector, so the fund manager's ability to navigate through the volatility and to find opportunities will be crucial. For Singapore investors, the Sing Dollar share class of this fund have a short track record, so going with the US dollar class may be more ideal. All in all, the AB International Healthcare Fund looks to be a good candidate for investors looking to add a long-term healthcare sector play into their portfolios. This concludes my absolutely biased comments on the AB International Healthcare Fund. If you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.